All right, my friends, let me ask you a question. Is the market riskier now in January of 2024, or was it riskier in January of 2023? All right, so comment down below. Riskier now or riskier a year ago? I'm going to throw a curveball at you here because it's, and you might be surprised what I say. So just read and listen to my course. Just got to make sure all things good to go. Not make any major mistakes. Make sure the audio is good, and of course it is because I'm crushing. And let's talk about who you are as an investor is one of the lessons. Lesson 25 is identify you as an investor. And the way I look at myself as an investor is for say every $100,000, I say if I lose 25%, that's 10 mortgage payments. That's how I identify myself. Can I afford to lose 10 mortgage payments? And so last year, or the year before, I can't remember. Maybe it was in 2022 now. I can't remember. But at some point in the last 18 months or so, I bought a federal home loan bond. I guess it was last year. I was paying 6% because I said, I don't want to lose 10 mortgage payments. So I'm still 50% in stock, and probably 65% in stocks. But I said I don't want to lose 10 mortgage payments. So I put a quarter of my portfolio in cash, a quarter of probably not a quarter, but we'll just say a quarter of my portfolio in long government bonds, and just to make sure I didn't lose 10 mortgage payments, if that makes sense. Because I don't want to lose 10 mortgage payments because I was all in stocks before. Especially if you're self-employed, it's kind of nerve-wracking to think, what happens if? You see what I'm saying? So I needed some liquidity because I just got done paying taxes, a massive tax hit, and then we put all our cash into doing our screen-in porch, which wasn't cheap because we did that Trex, deck stuff, and that stuff ain't cheap, but man, I love it. It's freaking fantastic. Anyway, so we invested quite a bit in our home. And I said, man, all the cash I had on the table is gone now, so I still got a mortgage though. So I want to make sure my tush is covered. All right, so believe it or not, the market is riskier now than it was in 2023, at the beginning of 2023. And yet I guarantee you're feeling less consternation about the markets now. I guarantee you are. And the reason is because the markets went up. Now, there is something about trends and momentum, I grant you. But the long-term performance of the markets are always based on current valuations. All right? Oh, I'm about to sneeze. Am I about to sneeze? Oh, hold on. Oh, maybe not. I just got yawned. When current valuations are high, long-term performance is low. When current valuations are low, long-term performance is high. High and low are relative. But the facts are valuations are higher in the markets today than they were a year ago because the markets did so well last year in 2023. In 2022, the markets were down 18%, the S&P 500. Not top to bottom, but just for the whole year. Not full bear market, but it was a bear market within the year of 2022. All right, so we were down about 25% top to bottom in 2023. And then we ended up on a little bit of a high note, so we only dropped 18% total. So last year, though, we're up to 24.5 or 25% or something like that. All right, so we have higher prices than we did last year. Did earnings go up 25%? No, they did not go up 25%. So we have higher prices relative to earnings, which means there are higher valuations from a PE ratio, price earnings ratio. And as such, if you look at things like the cyclically adjusted PE ratio that Shiller does, Robert Shiller from Yale, CAPE, and I like CAPE ratio. I think a lot of people put a lot of emphasis, oh my goodness, a CAPE ratio, without focusing on the other alternative, which is bonds. So a lot of these doomsday are like, oh my goodness, CAPE ratio has never been this high except for 2000 and 2008. And what they forgot to look at was the alternative investments in terms of safe money. And bonds were the safe money, and bonds weren't paying crap back in either of those days. So if you look at the CAPE, cyclically adjusted PE ratio, and that just levels off your last 10 years of PE ratios, as opposed to saying in 2020 March, the PE ratios were like at 8. Well, the only reason the PE ratios are at 8 is because the prices had fallen so much, and yet the earnings hadn't been reported yet. I mean, that's one of the drawbacks about looking at, annualized PE, or not annualized, month-on-month PE ratios is when we had these huge falls in the prices, and we did not have yet the huge falls in the earnings. It looked like it was a cheap market. It just was. I mean, it turned out to work out great, but it wasn't a cheap market relative to earnings because the earnings hadn't been reported. I talked about that back then. All these people like, oh my goodness, I'm getting a PE ratio of 8. This is like 1982 all over again. Like, well, wait till the earnings come back. You know what I'm saying? Wait till the earnings on Delta and Carnival Cruise Lines and all that come back, and the PE ratios won't show 8. Again, the market is based on the date, minute by minute. The earnings are based on quarter by quarter. So the market, the PE ratio can be misleading. Let's just put it that way. Because the prices are fluctuating so much and so fast, and the earnings only get reported once a quarter. In fact, Trump, to his credit, said earnings should only be reported once every year, because it's insane to have these quarterly earnings calls and whatnot. And just, quarter by quarter, these stock guys like, oh, it's short-term investment thinking. And you don't want to be short-term. You want to be long-term. But that's how these people get their bonuses and stuff. It's crazy. So Trump said, no, let's just make these things annualized, not quarter by quarter. And that never went off, which is too bad. And when Trump wins again, I hope he revisits that. Get rid of the quarterly conference calls, the quarterly earnings reports. Let's go annualized. It'll make everybody more efficient, that's for sure. And we can spend less money on quarterly reports and more money on efficiency on the companies at hand. Anyway, so going back to this, so now we had PE ratios that why are you going so slow, dog? PE ratios are cyclical annualized PE ratios. That just means they're going to level them out over 10 years as opposed to quarterly, what the PE ratios do on any given year. Because we get years where we get hit hard. Again, oh man, that tree's about to fall on those power lines. Dude, I got a guy who's literally like going, oh, there he goes. All right. Pokemon, let's go play some Pokemon. I think he's trying to go to the open house, but the open house is the other way guy. Anyway, I'm in Cherokee County. Lots of Trump signs out here. Last poll, Trump was beating Sniffy Joe by 9 percentage points. 9, last poll. Now, do I trust the polls? Nope, I don't. But generally speaking, the polls are definitely geared towards the Democrats, not so much the Republicans, because the media controls it, and the media is heavily left. And so if I see a poll that shows Trump winning by 9, I'm like, oh, that's good, in Georgia. And just a bunch of Trump signs here in Cherokee County. If I had to redo it, I'd live in Cherokee instead of Fulton County, you know what I'm saying? But I have a good friend of mine, Jordan, who lives in Cherokee County, and he likes it. Schools are good. And it's more country. I'm a little bit country. How's that song go? Anyway, it's just a little bit more rolling hills, a little bit more country. Fulton County is Fannie Willis. That's all you need to know, man. All you need to know. Old Fannie. Take a load off, Fannie. Take a load for free. Take a load off, Fannie. And you put the load right on me. I can't remember the guy who wrote those songs for the, it's not Canned Heat. Oh, it's not, not Canned Heat or Uriah Heep, the band. The guy who wrote those songs for the band, man, freaking great songwriter. I just can't remember his name off the top of my head. Anyway, so the markets are riskier now, my friends. So I'm telling you, man, I'm seeing bad things. People email me, Josh, should I get more aggressive? I'm like, why weren't you saying that? Like, if you're one of those guys that email me, I'm not yelling at you, but why weren't you saying that last year at this time? Why are you saying it now? Because the fear of missing out. Like, you weren't saying it last year because the markets were down and you thought they were going to go down more, and yet they didn't go down no more. They went up, and now you're saying it. And yet price-to-earnings ratios are actually worse for you valuation-wise. Oh, man, it's a nerve-wracking thing when people start getting cocky. And this isn't cockiness, it's a fear of missing out. Like, man, the markets are up. I'm not sure what I should do. Well, you weren't saying that last year. If you weren't saying it last year, why are you saying it now? The only thing that's changed is the markets have gone up, which means that inherently the markets are riskier today than they were a year ago. All right, love to hear your thoughts. God bless.